Let's get across the market open. Kyle Ryder joining us from Capital.com. Kyle, welcome to Thursday. Focus overnight very much on the latest US inflation data, which did surprise to the upside.
Yeah, it certainly did, and that core number was at 3.3%, far exceeding the 3.1% expected and higher than the 3.2% from a month earlier. So clearly, inflation is still a problem in the United States that's sticky, and arguably over the last sort of 12 to 18 months has actually been more or less moving sideways with, some periods of softening, but only very, very marginally. So it certainly raises the question about the level of restrictiveness of Fed policy in the United States and to what extent current conditions might be suitable for getting inflation back to target. Remarkably, the markets were fairly resilient despite the news. We did see a bit of a pullback at the initial release before a bit of a recovery because of some other news, it has to be said as well. But overall, now we've got the markets pricing in that the Fed will only cut once more in this cycle. That'll be at some point in towards the end of the year. The first cut is fully baked in for December. And what really has to be said is that, despite that inflationary shock, the risks to the upside coming from tariffs as well as maybe looser fiscal settings, we have equity markets holding up reasonably well, or certainly better than previous upside surprises, or when we've seen previous upside surprises to inflation data. So the market today looks as though it's going to open reasonably solid. Asian equities look like they are going to open reasonably solid. But again, if we're relying on rate cuts to keep this market moving higher, or equity markets moving higher, increasingly it looks like that won't be a tailwind.
Yeah, there's also that growing concern, as you alluded to there, Kyle, just over a widening global trade war. In fact, President Trump expected to announce those reciprocal tariffs on pretty much every country that charges duty into the States. That's likely to happen tonight.
Yeah, and we'll be waiting for that. And again, it's another sort of point to make that, equity market over a week or so, at least since that kind of initial shock of the tariffs on Canada and Mexico, which of course were delayed or potentially we'll see withdrawn. We've seen these sorts of trade war developments more or less shrugged off and investors taking the risk of an escalation in stride. One has to wonder how long that would last and what it would take for the markets to start waking up to the prospect of a fairly significant race to the bottom when it comes to tariffs. And already we've seen Europe slap some tariffs on the United States in response to the threats of tariffs on things like automakers and what have you. China has also applied some trade restrictions as well. And there's these other questions about if there are across-the-board tariffs applied by the United States on all of its trading counterparts, whether that will set off other major economies to increase trade barriers as well. So that's, in the short term, a significant risk to inflation, just on the basis of that kind of one-time price shock that, if nothing else, we will certainly see from tariffs and will complicate the Fed's job, create a lot of noise in the data going forward. But also it is a significant risk to growth going forward, both in the United States, but across the globe as well. And because we are seeing that kind of stickiness in inflation, more broadly speaking, it raises that prospect that maybe we'll see not a stagflationary mix, but a bit of a stagflation-like environment where prices are slightly elevated, maybe ticking higher in the short term, while growth does slow down. So again, we've got equities still around record highs, sort of shrugging off these concerns, but these things can be very much non-linear in their behaviour, and as a result, cause a fairly significant sell-off in markets if things really do start to deteriorate significantly, and we do start to see this kind of race to the bottom dynamic on tariffs.
Now, Kyle, ahead of perhaps Trump announcing further trade details there, he's also been busy on the diplomatic front, making phone calls to both President Putin and President Zelenskiy in an effort, he says, to try to end the Ukraine war. What effect has that had on markets, I guess, particularly in oil?
Well, I mean, the clearest sign obviously has been in energy markets. Oil was down 2% last night off the back of the news, also driven by a little bit of a jump in US crude oil inventories last week, or data that was released last night about last week's inventories. But effectively, one of the reasons why we did see the market shrug off this inflation report was that we did get that news coming through that perhaps Trump has successfully brought both sides to the table, or is setting them up to sort of arrive at the table for negotiations. And there's this kind of, obviously nascent hope that we could see a fairly significant breakthrough there. From my view, 17,000 kilometres away in Melbourne, it seems very unlikely that we'll see a significant breakthrough anytime soon, because if you do look at what the Trump administration has flagged as far as what it thinks would be a suitable compromise between both parties, it requires giving up territory when it comes to Ukraine. It also requires that the door is open for Ukraine to enter the EU. It also says that Ukraine won't be allowed to enter NATO, and put a line under that as well. And given the risk that for at least the Ukrainians, that yes, they could get potentially some kind of compromise here and a pause in the war, and effectively it would be a pause in the war by more or less compromising on some of those things. The fear would be if they are more or less ruling out NATO membership, and that they do allow the Russians to take further territory, that when someone like Trump leaves office, which it would seem that Putin is more or less amenable to the idea of negotiations because of Trump's presence in the White House, and perhaps his view that he can sort of manipulate Trump more or less into doing Russia's bidding, or at least serving Russia's interests more than other potential US presidents, then that is a bit of a deterrent for Ukraine to really make any kind of peace deal right now, on the basis that it might only be a sort of two or 3 year détente before Russia is emboldened once again to push further into territory. So it is a really significant development that we do have this open dialogue. There was a positive response in the markets as a result, especially in oil, but certainly in equities as well. But the prospects of breaking through with a deal is, still a very, very high bar to meet, and I still think, largely should be treated with a degree of skepticism.